delivered some of the most exceptional same-store sales growth numbers in the entire QSR industry over the last 5 years. The stock has been a category leader, the unit economics are exceptional, and the delivery forward model is built for how consumers actually order food today. But Wingstop NNN investing has some specific characteristics that every buyer needs to understand before writing a check. Let me walk through all of it. Wingstop NNN properties trade at 6% to 6.7% cap rates, reflecting the non-investment grade parent credit of S&P B+. Buildings are small, 1,800 to 2,500 square feet, often in end cap or smaller pad configurations, not always a freestanding corner pad. Entry prices run $1.5 million to $3 million. Lease terms are 10 to 15 years, shorter than the pharmacy and QSR drive-through categories. Most deals are franchisee guaranteed since over 95% of Wingstop locations are operated by franchisees. Wingstop corporate credit is below investment grade. Wingstop's financial performance as an operator is genuinely exceptional. The company has delivered consistent double-digit same-store sales growth for multiple years in a row, a feat most QSR chains cannot match. The business model is designed for the delivery era. Small footprint, no dine-in requirement, optimized for online ordering and third-party delivery apps. That operational efficiency translates to high royalty margins for the franchisor and strong unit economics for the franchisees who sign the leases on your NNN properties. For investors who want to participate in the best performing QSR category through NNN real estate and are comfortable evaluating individual franchisee credit, Wingstop offers wider cap rates than the investment grade alternatives. Wingstop leases are typically NNN with 10 to 15 year initial terms and renewal options. Rent bumps of 10% every 5 years. The guarantees are primarily franchisee guarantees. The identity and financial strength of the individual operator is the key credit variable on every deal. A Wingstop franchisee who operates 20 locations is a categorically different credit risk than one operating a single store. Always get financial statements from the franchisee guarantor. The most important thing with Wingstop is the franchisee credit analysis. Get financial statements. Understand the franchisee's other business interests, number of locations, and operating history. This is not optional diligence. It's the core of the investment decision. Second, Wingstop's corporate credit is S&P B+, well below investment grade. The company's outstanding operating metrics have not yet translated to investment grade credit because the company is still growing into its capital structure. Third, the delivery forward model creates different site criteria than traditional drive-through QSR. Wingstop locations don't need to be on the absolute highest traffic intersection. They need to be accessible for delivery drivers and to the delivery zone. Understand the market-specific logic of each location's placement. Fourth, shorter lease terms of 10 to 15 years mean you'll be in the renewal cycle earlier than with a 20-year QSR deal. Understand your position on the lease clock. Wingstop NNN offers some of the wider cap rates in the QSR category, with access to a category that has genuinely outperformed. The diligence process requires more franchisee level work than a corporate NNN deal. But for investors who want to do that work, the yield can make sense. I'm Ryan Solberg with MaxLife Commercial. Visit maxlifedevelopment.com or call 321-586-2121.